Well, most of us are trying to cut back because of the tough economy, and our next guest says you better keep cutting back because inflation is taking a bite out of your savings and our national financial security. Terry Savage is a nationally syndicated personal finance columnist, and good to see you, Terry.
Good to be with you, Terry.
All right, let's talk about inflation. You say it's more than just the rising price of gas and food. What do you mean by that?
Well, what it really is the eating away of the value of our dollars. And inflation, you know, we have a generation that hasn't really seen inflation. Currently, it's a little over 4% year over year in consumer prices. Historically, it's only been about 3.4% since they started keeping statistics nearly 100 years ago. But you know, at even that small rate, it adds up. Since 1913, at that average rate, we've had 2,000% inflation, which a better way of saying it is, in today's dollars, that would only buy $1913 is worth only 4.8 cents.
So a $1913 in today's dollars would be worth about a nickel.
About a nickel.
That's depressing. Inflation is important. Okay, you say this is a looming crisis. It could get worse because of what the Fed and the federal government have done to try to solve the housing crisis, the economic crisis. We've seen so much money pumped into the economy. You say people overseas, they look at our dollar and they're not so impressed.
You know, they're lending us a lot of money. We've been in debt. We go more into debt. Our budget deficit this year will be $400 billion. How do we get the money? Well, we either print it or we borrow it from them. Now, the Fed's also cut interest rates. If you're in Middle East and selling oil, if you're in China with all those dollars we've sent over there,
right,
aren't you going to be a little bit upset at interest rates? My mom's upset that rates are only down at 2%. How about if you're the Chinese central bank? We're printing more dollars, rates are only 2%. We're not going to lend to you unless you raise rates.
Let's get to some advice, because I think our viewers out there are really interested in how they combat this problem, because this is affecting them at every level. What do you suggest they do to combat this inflation?
All right, well, first of all, if you're a borrower, inflation benefits you in a way. You pay back with cheaper dollars, but only if you borrow at fixed interest rates. So if you have a floating rate mortgage and you can refinance, you definitely want to lock in a fixed rate now at these rates.
And the good news here is that those rates are pretty much historical lows, although not the lowest.
Exactly, and if your home is still worth it, you definitely want to take steps to lock it in. All the other debt you have, you want to pay it down. You want to pay it down because credit card rates will go up, because every other piece of debt that you have will have a higher interest rate, and you don't want to be buried in debt.
Terry, tell me, okay, I'm saving for retirement, my 401k. This kills bond prices, right? I mean, what do I want to invest in now, given the fact that inflation, as you say, is going to go higher and higher?
It's very interesting. People email me. They're scared of the market, the stock market. They see the market going down because of inflation fears, because of higher energy prices.
Right.
So they're scared to be in the market, which actually, over the long run, has beat inflation handily. So they're telling me they want to buy bonds, and I say, oh no, bonds can be as dangerous as stocks. If you lock your money up for 10 or 20 years at the current rates, inflation always brings with it higher interest rates. And so your current bonds at 5% won't be worth that $1,000 if you have to sell them in 2 or 3 or 4 years, and other interest rates have moved higher. So then they're left with money market funds. Well, 2%. Gosh, that doesn't even keep up with inflation.
You're losing money in a money market fund. CDs, Terry, quickly.
Well, CDs, short-term rates are all just below inflation. If you pay taxes on the interest, it's worse, but it gives you flexibility. And if we are going to have inflation, rates will rise. You'll be glad you stayed short-term, what I call chicken money, so that you can take advantage of rising rates in the years ahead if we have inflation, if it gets out of hand.
Terry Savage, you are the author of The Savage Number. We appreciate your time today. Thanks, you.
Terry.
Allie?
Well, the reason we do this program every day is because most of you said the economy is the #1 issue facing this country. So it's time now to hear from you. The phone number is 866-792-3399.
And we have a dynamite panel today to help out. Mike Santoli is with Barron's. Terry Savage, that is a personal finance columnist from Chicago. And Doug Flynn is a certified financial planner.
Let's go to Sheila in California. Hi, Sheila.
Yes.
What can we do for you?
Well, I'm 57 years old, single, self-supporting. I am currently invested in my company's 401k, and I have a feeling it's tanking. I'm just wondering if, at my age, I should stay where I am or go with something a little more lucrative.
What do you think, Terry?
Well, tanking, you'll have a choice of investments inside your 401k plan, and these days you can move at the toss of a dime. You can call it tonight. So what you need to do is take a look at what funds you've chosen inside the plan, But remember that you're going to retire probably 7 or 8 years, but you're going to live another 20 or 30 years beyond that. So you need to plan for long-term growth, and you do need stocks, a stock market, diversified stock market fund within the 401k plan. So you don't want to run, but you want to think carefully. Now it's a good time to think, am I diversified?
Yeah, diversification is key. Terry in Nevada has a question. Terry, are you there?
Yes, I am. Hi, thank you for taking my call. My son will be entering Syracuse University this fall.
Congratulations.
Oh, thank you. And, of course, even with his scholarships, there will be a tuition balance. Now, the university does offer a monthly payment plan that is extended over the academic year for a $60 annual application fee. And so I'm trying to figure out, is this going to be more advisable than, say, a student loan, which would then build up his credit, etc., or possibly just leaving all the funds, taking advantage of this, and still keeping his college fund, basically the bulk of it, intact over the next years because of all the volatility.
All right, Mike, you got to weigh in on this. This is always a critical question. How do I finance my child's college education?
I would say, honestly, if the monthly payments are affordable and if there's not an egregious interest rate on top of that, if it's simply spreading the tuition payment over the 12 months, I don't see a reason not to do that if the alternative is taking long-term savings out that's already accumulated.
All right.
And current student loan levels are at a much higher rate than you're going to, or they're now fixed rate student loans. Even if they're deferred on the interest, their interest cost is very high. So if you can avoid them and pay with your own money, you'll be much better off in the long run.
Angela in Puerto Rico, welcome to the show.
Hi, how are you?
Good, thanks. How are you?
Fine. Thanks to watching Issue 1 every day, and with scores of over 800, we just bought a brand new builder's inventory listed at $358 and paid $285.
Wow.
In Austin for a 5.25% fixed. We are keeping our house in Puerto Rico, and we've never owned two homes. So my question is, when it comes tax time, which house can I take, or can I take both? Because we live in both places.
Oh, that's interesting. What do you know about that? Don't you have to live in one place more than 6 months in most cases?
Typically, you have to claim a primary residence, and then your second one is, it could be an investment home. If it's an investment home you're renting out, you get certain tax breaks, but if it's just going to be a vacation home, you really can't live in both places. One of them is going to be there for more than 6 months, even if it's 6 months and a day, that's going to be your primary. So there are certain things you could take on your vacation home, but you're not going to get the same write-offs as if it were an investment property.
Isn't there a $1 million limit on
There's a limit, exactly, on the deductibility on that second property, I believe, but I'm not the tax expert.
All right, well, it's a highly complicated question, and, you know, you might want to talk to your tax accountant on that. Let's take an email from Eddie in Massachusetts. He asks, I'm looking to become a first-time home buyer. I'm 25 years old. I have a secure job, and I'm ready to buy. Considering the state of the market, though, should I buy now or should I hold off? You know, this is a question that all of you should weigh in on, but let's start with Mike.
You know, I think if you want to catch the absolute bottom of house prices, you can never know you're going to be there. If you can afford the low rate that you might be able to lock in right now, if you can afford the payments, I think that one of the things that has to break is this mentality that your home is principally an investment as opposed to a place to live. It's a place you want to live, you can afford it, you can cover the costs of it. I think it's not a bad time to buy.
All right, Terry, do you agree with that?
I'd have to agree with that, especially because if we are going to have a new round of inflation, we'll see higher interest rates. So the home price might bounce back, but the mortgage rates might be higher as well. So you can't stand around waiting to get the absolute best point as long as you can afford it.
Agree, Doug?
Yes, I think that first-time home buyer, that means typically that the person is probably not going to intend to keep this home for the rest of their life. So you do have to be careful when you buy. If it's a home you're going to keep for 30 years, then it really doesn't matter when you do it. If you find a good deal, a good price, and good interest rate, just go ahead and do it.
Go ahead and do it. All right, unfortunately, people only hold on to those houses about 8 years these days. Let's grab that next email.
All right, Khalid from, I don't know where he's from, wants to know, we're just talking about interest rates. Are my school loan rates affected by the federal funds rate? That's always a question. When the Fed cuts rates, people want to know whether it affects their loans.
Good timing on this question because student loan rates will drop on July 1st for older loans. Now, if you took out a loan last year or the year before and in this coming year, those loan rates are fixed at much higher rates, over 6%. But if you have floating student loan rates, you can consolidate after July 1st at a much lower rate. So the lower interest rates on Treasury bills set the lower rates on adjustable rate student loans. And after July 1st, you want to look for a consolidation. That's not going to be so easy to find. A lot of banks have gotten out of that business this year, though.
All right. We're going to continue to take your calls.